Welcome everyone to which stock to trade today. I think the stock to trade probably Disney, but I've got a few things to go through because what the market is doing right now is almost a carbon copy of what it did last week. And last week, if you'll recall, I was really advocating the idea of don't buy anything. This market's going to go down. And I think that was a pretty good assessment considering how the week turned out. Let me show you what's going on right now, what I think is likely to take place in the next 60 minutes when the market opens, or 60 minutes from now when the market opens, and why Disney might be a good try. But there might be some others we can find that would be even better. So let's get going on which stock to trade. I'm going to share my screen with you here. Hopefully, oh, that went kind of quick. I'm not sure which screen I'm sharing. Let's see. Are you able to see a chart or my profiles? I'm hoping that you can look at that you're seeing. Oh, you're not seeing it yet. Okay, try that again. Screen, and we'll go this screen, and we'll go there. And hopefully what you're seeing is a screen of the Aussie yen and NASDAQ futures. And we've got the Aussie yen on top and the NASDAQ futures. These are the 5-minute charts. Now only seeing you on a black screen. No screen. Okay, well, that's interesting. We'll try that again. Maybe I need to do that. Okay, we there yet? Oh, still no. So, you think I'm on a slow connection? Yeah. Wow. Okay. Let's see how to solve. Let's try something a little simpler. Maybe this will work. Okay. Are you able to see this? Hey, hello to you, and you're welcome. Sweet. Good to see you back. Are you guys still or not yet? You know, I think I may have started the, yeah, who can start sharing, someone else is sharing. Yeah, the advanced sharing options. Looks like we have some new sharing options here. What if I just shared that one? Okay, how about that? Are you able to see charts? Yes. Wow. Okay. Let's stop the share. Give me a second here. I'm going to try and creative. I don't know if this is really going to work out as well as I want it to. if I cannot actually share my screen, then maybe I can show you my monitor behind me, large monitor, and I can put this onto the large monitor. Work from there. Okay, you see me, you can see the large monitor. That's good. We're gonna go like that. Excuse the lo-fi here. And then I'll try to make them really big as we get going. But for now, here's what we're going to talk about. See how this is the Aussie yen. All right. And this line I have right here, this is really kind of an interesting tree. At least I hope it is. Maybe I can get a little more light on my face. Hang on a second. There we go. This is the Hull moving average, HULL, Hull moving average. And let's see. Let's do that. Sorry, give me a second to. So this line going across the middle of the 5 minute, it's the 5 minute Aussie yen on top, NASDAQ here. This is starting at the weekend. So this is what's happened since the weekend changes. The markets reopened after the weekend. And this line in the middle is the Hull moving average. It's the 120 moving average, kind of a long, large moving average. There's a reason for that. The Hull HULL moving average, what it does is it actually takes the weighted, couple versions of the weighted moving average and then smooths it. It's very wonky, but the bottom line is that what it does is it takes a large section, sort of takes all the data and says, all right, starting from the center to the end, giving a little more weight to the end, what's it doing? What's the average looking like? And the reason that that's useful is that it makes it so that what's happening when the calculation gets to the end is, everything that's happened more recently is more important than what happened further back, but it's still keeping track of what happened further back. So you can get a long period moving average with less lag. See, the thing is, you want to build in all this data, but then if you on a simple moving average, every data point is the same as the others in terms of importance. And so then you get right here and you're like, it's giving you the average of clear back here, and you're like, well, I don't really care about what was a few hours ago. I need to know what's relevant right now. So anyway, the whole moving average, its math is designed to try to address all of that, and it actually does a fairly good job. So for a longer moving average, what I did is I put this on Thinkorswim charts so that in real time we could see, hey, what does the trend really look like? And it just goes green colored if it's up and red if it's down, right? Well, right now we got green and green on both of these. Interestingly enough, though, the starting point here, you just look at a straight line. Where was I when I started? Where am I now? That's up on the Aussie yen. NASDAQ, that's down. Okay. That's how we were last week. I remember we said, one's going to pull towards the other because they stay highly correlated. So which way are they going to go? And they went down. It was just like this last week, and the markets went down. So we could say, oh, well, that is an indication that the market's going to go down, right? Well, I think that's less of an indication here. Last week, I told you that the end of the quarter was a thing, and that was really important. And what was likely going to be happening was the the rebalancing. Rebalancing wasn't the word I used, but quarter end for hedge funds, they do stuff. I thought it was really funny because um, Investopedia actually did a story on that and published it. Well, they updated it back on July 4th, but then they kind of rebrought it, put it out on their main page on the headings, and said, "Hey, it's end of quarter, so let's just dredge this article back up." And so, what does the end of quarter mean for portfolio management? So there's a fascinating little item in here. It says the end of quarter refers to the conclusion of one of four specific 3-month periods, right? These are considered important times for investors. And then, so down here below the important SEC public requirements for reporting, it starts off with this little sentence. It says, there's a widely held belief in financial circles that hedge funds, pension funds, and insurance companies always rebalance their portfolio at the end of the quarter. While no proof or evidence has ever been put forward to confirm this practice or its prevalence, the very idea reinforces the concept that the end of a quarter is significant. Okay. I'm on the financial review board for Investopedia. And so I am going to be emailing today because I just found this right in preparation for the show. I'm going to be emailing these editors and let them know I have a recommendation for them that they need to modify this language because I'm really glad they did this because what they're saying is, the people that are writing this are not trying to be dismissive of the idea. They're just like, well, yeah, a lot of people believe that, but it's not like there's any proof of that. Actually, there has been specific data study proof associated with this. It has been put out there in the I believe it went to the Journal of Portfolio Management. And I mean, I wrote articles for Investopedia on the Santa Claus rally, the end of the year. The past 2 years running, I've done this, and I've made reference to the study I looked up that showed that. And here on the site, they're saying no evidence has ever been put forward to this. Well, yeah, there's totally been evidence put forward to this, and that's why I talk about it, because I don't want to just repeat lore. And it's an interesting lore. They point out the fact that the mere fact that lore is out there, the mere fact that somebody came up with the idea and everybody thinks it's interesting, means that, well, it's kind of self-fulfilling prophecy. No. It's more than that. It's more than that, because especially the December 31st quarter, the January effect, right, Stuart? Yeah. I mean, the articles that I've written the past 2 years, at the end of the year, between the holidays, they all go on vacation. Investopedia guys, they all go on vacation. And so when I do my newsletter, they tell me do it ahead of time. And what? I'm gonna seek into my crystal ball and say, so obviously I can't write about what actually happened at that moment in December 28th, 29th, 30th, whatever, or those days that are market open days, but all these guys are on holiday. And I can't write about exactly what happened in the market. So I always write about this stuff, the end of quarter effect, the January effect, the January barometer, and I go back and I go through the data and say, here, look at what's happened today. I mean, I can't show it to you because I can't capture it. I had captured this 4 or 5 days in advance and compare it to what I wrote about. So that's what I always do. So because of the fact that I've done that the past 2 years, I've been studying this data, and I know that there's data. I know that there's actually been stuff put forward. And what there was put forward is an interesting, there was at least one. There were a couple others that kind of mentioned this. The one that hit it head on. And it was something called the turn of month effect. And it was studying whether on the month effect than you do otherwise. And it's there. It is actually there. It is demonstrable. You can see that you do get better gains at the turn of month. And the writer hypothesized this could be because 1 out of every 3 of those months is a quarter. And so I started looking at that and saw that it was there. I mean, it was not too much different from the end of the month. So I don't know whether it's large pension funds rebalancing every month, or if it's individual users or whatever. But what happens at the end of the month, and when that month is the end of a quarter, is significant. And the typical, what the study showed was that the 4 days going into the end of the month and the first 2 days after the beginning of the month were, if you bought during that period of time and then you held for 1 month, you have better average performance than all the other days of the market. It's really, really fascinating. But what that means is if we were to be a buyer right now, then statistically, we would be making a trade that had a little bit of an edge, a better edge. And that's why I say we might want to be a buyer, even though we've got signals that are showing up as not necessarily good buy signals. I mean, last week they were very good sell signals, right? So in fact, while I'm here, let me go back to that and bring up. So this is how, this is the candle chart is the S&P 500. The line chart is the NASDAQ 100, okay? This is how we ended the week last week. There's a big head and shoulders pattern. All right, and it's there on the NASDAQ too. Sorry, I'm going to move that line that jumps around a bunch. There, okay. So the head and shoulders pattern on the NASDAQ, it fully broke through. So on the S&P 500, I drew it a little bit different, and according to this, that line, it hasn't broken through. Now you'll notice that these are sloped. The NASDAQ is sloped up, the S&P is sloped down. But the NASDAQ has broken through and pushed. I think that's going to put a little more selling pressure. I think it means that the S&P 500 could do the same. Could be a real brutal week. Could be a really big, bad, ugly week. So why am I talking about being a buyer? Well, because maybe it isn't. But let's take for a moment the idea that it's going to be a big, bad, ugly week. Just kind of like last week. So you mean 1, 2, 3, 4, 5. We had this tiny range on Monday, and then boom, down we went, right? Real ugly. And then I actually lucked out in the sense that on Thursday, I thought, okay, that is the end of the month. And then because we've sold heavily right through those last 3 days of the month, there's probably a good chance that institutions are going to want to jump in and buy the first day of the quarter because they got out up here, right? We talked about that you got to get out and hold some cash if you want to get ready for the next quarter. And that's what institutions do. They get their money out. I mean, not everything, right? They just get some. They build up a little. They're dealing with billions of dollars. It's not all in or all out on everything. Number one, it's illegal for them to do that. Number two, it's not efficient. If they tried to do that, they'd push prices too far, they would lose their profits. So they take a little bit out and then put a little bit in. And when they do that, when they know, okay, I want to be a buyer during this period of time because quarter end or whatever their metric is, then I got to get ready by taking some of it out, having it settle for 3 days and getting ready to put it back in. So that happened. We know that happened because they stopped and then they held 3 days. And then what happened after 3 days on the first day of the quarter? Buying, right? I anticipated that buying was going to be coming along. So I actually got out of my positions, my put option short positions that I had on. I was really glad that I did because, of course, so on Thursday night, I went ahead and closed them. And then when Friday came and went up, I thought, I'm a genius. Well, I wasn't a genius. I just got these, short little moves down, but it worked out. Now, how about jumping back in? Because, hey, if they bought one day, maybe they're going to buy again today. I think that's actually quite likely that it's that 4 days before and 2 days after that period of time. There are optimistic people being buyers. The problem is what comes after that. And I think that these lines and that divergence we saw on the weekend coming out, I think that's setting up for another down week. Could be wrong. Now, here's how I'll know if I'm wrong. If we get in and stocks, I mean, if we open up and stocks really move high today, they gap up a little bit and then they just keep going higher, even making it. I mean, it's just a big up day, right? And what that means is that the sellers, there aren't people there aren't institutions and retailers that want to be sellers. There's everybody wants to be buyers. They're all trying to buy. They see this as a dip, and I was like, time to buy it, buy the dip, jump in. If that's happening, then that through the rest of the quarter, from now until the end of the year, stocks are likely to drift higher, just the same way that they've been doing this in the previous quarter, right? So that's a very real possibility. And I feel like today is a key indicator of how that's going to happen. If in fact we're going to see markets drift higher, then today should be a big up day. If today is just slightly down, or maybe it goes up and then comes back, like I don't see a recent example of a day like that on this chart, but it opens, it goes up a ways, and then before the end of the day it comes up and goes down. That's actually the day I'm expecting is that we will see some people attempt to buy, but there will be more people who want to sell. The reason I'm expecting that is that I feel like the year has been great for a portfolio manager. The first 3 quarters of the year have been fantastic. They don't need a fourth quarter to come along and give them a good year. Of course, they're going to try and stay with the market averages. So, I missed this comment. This might be a good time to fold this comment in, right? Is that in the middle of this sentence? My says that there's a question that came through. How do I research on stocks? Which sites do I visit for research? If it depends on the kind of research that you're looking to do, right? Are you looking to do research for a trade of 2 to 5 days, or are you looking for an investment? How do I get in? How do I buy? Hold for a few months and hope that my stock's going to do better than the rest of the market. Okay, well, the first thing you got to do, here's how you do your research. Most people tell you, well, look at the company, see if it's a good company, and see if it makes good things that are in demand and so forth. That's not a bad idea, but there really isn't any statistical evidence that figuring out whether the company is good is actually going to help you make a winning trade. That's the part that institutional investors or academics and so forth, and big banks who talk about what's the best way to know what a good stock is. Even the guys that are doing it, they kind of overlook the fact that there is no statistical evidence for the idea that, hey, if the company is doing well and I buy them, from the time I buy them to the time I sell them, I feel guaranteed that I'm going to have a better outcome, right? There's no evidence that looking at fundamentals helps you achieve that, which is strange because the market does, U.S. market does nothing would go up over the past 100 years, right? Well, I mean, there's these periods where bear markets, they're bad, but generally speaking, 2 out of 3 years always end up going higher. So if you're buying good companies, then in theory, you should be going higher too. Yeah. That's all of that is true. Except here's the problem. Nobody can study particularly when you put in and when you get out. And that period of time, therefore, you don't have specific evidence. So what I do is I look at the markets and I say, okay, let me just assume that it's all random because everybody's going in and out of it all the times. What am I going to try and do? Well, if the markets are random, how can I expect to make any money? The answer is that prices tend to trend, even if they're random. That's the amazing thing that most people do not know. It's out there for everybody to find out for themselves. The reality, the database reality is that even random data creates trends. I just taught a class last week on why that's so. Explanation is long. I'm not going to give it here. So what I do then when I'm doing research is look at the market and say, do I see a trend? And can I think of the reasons of why that trend, what's going to drive it? And then what does that mean? How much can I get out of it? How much of the trend can I anticipate for there to be? And then which stocks are likely to benefit best from that trend? Okay. So can I see a trend on the data? Do I have a fundamental reason why that trend might continue for a period of time, say 1 to 3 months, and which stocks are most likely to take advantage of that random trend? Okay, that's what I'm doing right here, right now with you. That's what I'm going through. I'm looking through this data and I'm saying, what about this fourth quarter? Now, when you're coming here and you're trying to find ideas, I'm talking about trades. I'm talking about stuff that's going to be in the next 1 to 4 weeks. I'm going to get in and I'm going to get out. And I'm going to keep doing this in such a way that I expect to have better gains than that market average. And whenever you attend my classes, you get specific ideas on how to do that, or how to judge what kind of trading results you get, and how to get your win percentage where you like it and so forth. Right? That's why I do what I do, because that's actually a way to create a trading system that gives you the statistical expectation that you're going to have better than average profits. Okay. So with that in mind, I am noticing that we're looking at the possibility of turning down. I think that the bigger emphasis is that the market, it's going to push the market now. And the reason for that is, as I was explaining earlier, we've had 3 great quarters. Portfolio managers, professional portfolio managers, they've had great quarters. They don't need to have a good quarter in the fourth. They can just sort of pull back, and even if the market averages go down a bit, they'll still end up doing well. And in fact, if they hurry and sell out ahead of the market averages, and then they're going to ride up to here, and then the market's going to start going down. Well, they're going to hold there and they're going to come out ahead of the market. And that's their whole goal. They just beat the market by a little bit. They get these huge, big bonuses, millions of dollars. And I mean, the guys that are running the funds, right? And I mean, push comes to shove, they're not thinking about, well, how do I make sure that everybody in my fund gets the very best, most possible money from my fund? They know they don't have any control over that. They know they can't ensure that. They just got to do their own job. I got to be a little bit better than the averages so that people feel like, I did good for them. And the next year, I'll get to come back and do this again. And if I do, I get paid hundreds of thousands of dollars, maybe millions, depending on how well I do. Now, there's another thing. You might think that the guys running these funds are, 70, 80 years old, incredible bastions of wisdom, Warren Buffett types. No, they're 10, 15 years out of Harvard or Yale or Wharton. Smart guys who grew up in rich homes. No, some. I know one guy. Has he had a portfolio manager yet? Probably not. I think he's just working with bond funds. Anyway, he grew up on the streets of Mexico and said, I am not going to be this way. I'm going to be a Wall Street banker. That's what I'm going to do. And he worked his butt off and emigrated to the United States and got into good undergraduate program, and then got accepted into Wharton MBA and went to work at a large investment bank. And really great guy. Javier is his name. I love him. He's a really great guy. But he is the exception by far. Most of the guys, really nice guys, smart guys, good guys, but they live in this world where they're just surrounded by super smart people, and they're young. They're I wouldn't say 30, more like late 30s to late 40s, right? That's who's actually doing the day-to-day portfolio management. Some other guy might have his name on the management, but he's like a team of these other guys, and they're like, yeah, well, just that looks good. Report to me what's happening. They're the ones doing the work, doing the getting anyway. And what are they doing? What is their goal? Are they worried about investors? No, they're worried about their job. And how do they do their job? Well, that's what I'm talking about. They have this. I start at the beginning of the year and I get pretty good. I can coast to the end of the year, especially if I think the market's going to go down. They're looking at the same stuff where, and they have even better data. They have reasons to believe why the market might be good or bad. Right now, here's an easy thing to think. Still not out of the woods with COVID. Don't know how people are going to respond. We know inflation's kind of going crazy. We know that inflation is eating into people's purchasing power. Oh, they can purchase lots of stuff. They just can't get as much value out of it because we know wages are going up. So that's going to push inflation even higher. And we know the Fed isn't going to lower interest rates anymore. That we also know they're going to taper. They're going to pull back their bond buying. All of those things together mean that there might be less money that goes to the market. Oh yeah, and the government's not doing stimulus checks. The U.S. government is not handing out stimulus checks in the last quarter. They are, but it's just a sneaky way. It's like they're giving out the child tax credit early, and so young families that have kids, not me, but my kids, they're getting money from the government every month. Just here you go, and the government says, well, yeah, it's just the child tax credit. We're just giving it out early. We were going to give them that, at the end of the money or at the end of the month, end of the year. But the sneaky thing is that they increased the child tax credit. So they are actually handing out more stimulus money. It's actually a very smart program. I hate to say it because I hate government spending. I hate government intervention. I'm libertarian, very much anti-government. But if you're a government and if your goal is I want to somehow stimulate the economy by putting it in the hand, giving out money that gets into the hands of people that spend it, wow, they're giving it to the right crowd by giving it to young families that have young kids, because there is an unending supply of wants in that area. And it's like, if you have a little bit of extra, we need to, tidy up the nursery. We need to build the backyard. We need to get a house, build a house, renovate the house, finish the basement. On and on it goes. We got to put these kids in soccer camp. We got to put them in music lessons. We got to give them this or that experience. We got to save for college. We got to, whatever it is, just continual wants and needs in that world. So good idea to be throwing money into that crowd. But other than that, everything else is kind of stopped in the way of spending. So I think that these institutional investors doing all this research and who love to look at fundamental research, they're like, this isn't looking good for the next quarter. It's possible that we're going to see less return, even if it doesn't go up, even if it doesn't crash and go down, it's probably not going to go up really strongly. So it might be a safe bet for us to lock in our gains. Okay. All of that, I think, is what's the mentality of that 40, early 40, late 30 portfolio manager who's out there in charge of millions of dollars of money, trying to figure out where should I put it, right? I think they're going to go put it in conservative places for the next 3 months. So that trend means there's more likely to be pushing down. How can I find a stock to buy that's going up? Well, I could buy the inverse funds, which is what I recommended last week. And how, what kind of trade's going to get? That trade's going to be a good trade for the next 2 or 3 months if we see that there isn't a lot of enthusiastic buying. Now, I could be wrong about all of that. That's what the template I'm going to start with. So I have to watch and say, where is it? Where's the evidence that tells me I'm wrong? The first piece of evidence I mentioned is what happens today. Will the market ride up strongly? And if it does, then I'm going to say, I was wrong about this being a selling selling quarter. it could be a buying quarter. Okay. So let's pursue the idea that I'm wrong for the first few minutes here and say, what would be a good stock to buy? If in fact we know stocks are going to be going up for the final quarter um, uh, of the year, who's going to benefit most from that? I would like to suggest that Disney is possibly one of those, but not for any of the reasons you might imagine. Now, first off, movies, Disney's got some hits. Um, they're doing great with their Disney Plus service. So all of those are good, right? People might be planning on coming back to the theme parks. And you might think, oh, that's a summer thing. No. I'll tell you what, Disney theme parks are year round. And in fact, the busiest time of the year is literally the end of the year, the Christmas holidays. Just those parks are crowded. And you say, but COVID, nobody's going to go. Yeah, by the end of the year, they might be, hey, everybody's vaccinated. Let's go, right? Or they might be like me. I just don't think I don't think the disease is something that people should freak out about. I don't think it's something we should toss the economy in the dumpster for. Um, it's I know it isn't the flu, but statistically and functionally, you can act like it's the flu. Did I ever, hide myself in quarantine over the flu? They have shots. I think we're going to get there. I think we're going to get to the point where people see COVID as just the equivalent of a really bad flu. I think the markets have already gotten there. They've been there for a year. But so societally, I think we'll end up going there. Yeah, mask wearing will probably continue. People will still be afraid of getting it and have varying and conflicting and contentious opinions about it. And that, but functionally, our day-to-day life, how are we going to go on living? I think we're going to get to the point where people just feel like yet another thing I have to worry about dying for. So I've managed to live with the uncertainty of life all this point. I'll just keep doing that and throw this into the mix, right? I think we're going to see society get there in the next 3 months. Unless, well, okay, I'm not going to go down that rabbit hole. But meanwhile, what that means, you see, is that Disney hotels, Disney movies, Disney theme parks. So the number 3 moneymaker for Disney is movies. The number 2 moneymaker for Disney is theme parks. Okay. But all of those, although they might be good, there's one thing that is the big moneymaker for, but far and away bigger, more highly influential moneymaker for Disney. It has nothing to do with Mickey Mouse. It is ESPN. So Disney owns ABC and ESPN and a bunch of other, media assets and studios and so forth, Pixar, right? But of all of them, the thing that makes the biggest money is the sports channel, ESPN. And within ESPN, the thing that makes the biggest amount of money is American Pro Football, the NFL. And that has just gotten started. Now, usually investors pile in money late in the summer on Disney because they know NFL season is coming and on, right? And they anticipate the gains. This year, because of COVID, nobody's really sure whether or not there will be gains. And the NFL's got a lot of, bad press for a lot of different reasons. So they're like, I don't think people are gonna. I'm betting it this way: everything that people didn't get last year from COVID, they are seeking out more of, sort of like, making up for lost time, overreacting, whatever it is. That's why you have shortages on this and that. I mean, there are other reasons too. That again is the rabbit hole I don't want to go down. But in addition to the rabbit hole reasons, there is just this simple fact of I didn't get enough of it before. I need more of it now, and so there's just these huge demand waves. I believe that the I mean, this past weekend um, the Church of Jesus Christ of Latter-day Saints, of which I'm a member, they had their general conference, which means that that they do a broadcast from Salt Lake City, and they watch. They Everybody all over the world watches that. Well, it's kind of a big time for families, my family, to gather. So I had all my kids over, and in-laws, everybody, not a whole bunch of people are together. And I noticed that among those that were there, the ones that really like NFL football, they weren't, kind of caring about it so much last year because COVID. I mean, they're kind of like, oh, what's the score at? But this year they're back to it. They're like, oh, what's the score? And if we aren't watching the conference, then we're checking out what the score is. And I just realized that's a thing. A lot more people are getting involved in fantasy leagues, and just the whole idea of the attention is coming back to what's going on with the NFL, what's coming back to the sporting world, right? You've got the U.S. Open a little while ago. You've got golf coming on. The soccer leagues are starting up in the U.S. and so it's I don't know what the schedule's like in Europe, but people are returning to stadiums. The stadium experience. Over the weekend, I went to a college football game. That was really fun to be able to go back to the stadium, and nobody had to wear a mask. You're there, and that was a lot of fun. It was so exciting, and a lot of people wanted that experience because they haven't had it for a while. So based on all of that, I'm predicting that NFL football is going to be a bigger thing. And who's going to benefit from that? Disney, right? So with that in mind, let's pull up a chart for Disney and analyze why Disney might be a good stock to consider. Take away the NASDAQ line there. All right, so here's Disney. What's it been doing? Just kind of been going up and down, blah, 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 in this channel, right? And where are we? We're down at the bottom of the channel, just coming up off of it. So we got this new day on Friday was very strong. There's a lot of selling, just like everything else in Disney, but it hit this sort of low part of its channel, and on Friday it bounced off. Now, on the regular markets, this movement didn't really get too much higher. It wasn't this huge jump from where all the selling took us. In this case, though, Disney, you see, it gapped up and then kept going, right? So this is another one of my favorite trades, the gap trade, right? It jumps up and big tall candle. So there's a little more buying on Disney than there is everywhere else. Even if all you talk about is just the channel, you got Disney at 175 going up to 187 or so. 12, that's about a 6 or 7% gain just to get from where it is back up to its old highs. But what if Disney broke through and then made new highs going on for the end of the quarter? That's a pretty good quarter. That's a good stock. So I feel like Disney is probably fundamentally and price wise a pretty good idea. Best of all, if you like trades, right, which I do, I like trades better than investments, then again, this sort of gap thing right here. There are three things that I look for on the gap trade. The first is that there's a gap and it's significant. Now, I like it better when the bottom of the green candle is fully above even the high of the red candle. But it doesn't have to be. Statistically, you still get an advantage as long as there's, just a good gap that you can see, which in this case there is, right? I also like it if this bar is a very tall bar, bigger than average. Well, it isn't bigger than, here, but it's a lot bigger than, what we saw going up to it. So this is a sizable bar. And so we got, the gap, and it's a green, and it closed closer to the high. There is a little bit of a bar right here, but it's not very big. So it closes, in the upper half. And so all three of those things are important. That's the minimum. Now, nice to have, even better, is if this movement from wherever it is here up to there, crosses above the 10-day moving average. There's a statistical, there is a study done that shows that there's evidence that if in fact that occurs, you've got a situation that is slightly better than random. When I say better than random, most of you know I'm talking about something that is maybe 3 to 5% better. And because that's, if the markets are random, the edges that exist are kind of ephemeral. They come and they go, but they do show about a 3 to 5% bump, and that's all you need if you're a trader and you're going in and out a lot. So I hopefully you can see that line. Now maybe I can make it thicker. Let's just get that thicker so you can see it over my shoulder. I'm going to make it a big green line. Now I'm going to make it a red line. I think that'll be easier to see. Oh, well, it's all about the same. All right. So there is the 10-period moving average. And notice that we went from being under the 10-period moving average to when it closed being above the moving average. Okay, got that? That is the nice to have. So this actually has 4 points of the gap trade that I like. Now, how do you participate in the gap trade? What you do is you buy the open of the next day. Now, 58% of the time, this actually comes down a little bit. It actually comes and you're able to buy a dip. So I'm thinking that in case of Disney, we could probably wait and bargain shop this trade and get Disney a little bit lower than where it closed. So instead of 176 and a couple of pennies or whatever it is, instead of that price, we could probably buy in the 175s, anywhere in the 175.50 plus or minus some. Probably even as low as 175 plus or minus some, but we'll make it easy to get. Let's call it 175.50. I think you could pick up Disney at 175.50 today, and probably have a good chance. Now, I better double check because I could be wrong about that. It could be that Disney is gapping up to start the day. So let's come here and look at this chart. On a chart that is not multi-grid, I think I'm going to have to do this. Change the layout. No, well, I'm just going to have to do this. Yeah. Yeah, this is working. So this is Monday. This is pre-market. What Disney's doing pre-market. Disney closed here on Friday. No. Okay, sorry. Disney closed here on Friday. That's the number we were looking at, 176 and change. And then it went up after the market closed, which is a good sign if you're bullish. If you want a stock that's going to keep going up, you love the fact that on a Friday after the market closed, when everybody went home, there were still so many people interested in it that they ran the price up. That's what happened on Disney. So that's a very bullish signal. But today, what happened? Well, it gapped down back to kind of where it was, and then it's slowly drifting higher. And so we're still looking right now at something higher, 176.20, little bit of a gap up, but only about 20 cents or so. So, it might be risky to try and sit back and wait. But I do think that there is going to be some selling come in. I think that's going to push prices down. I think it's going to allow you to get Disney lower. Now, if you don't want to risk missing the trade, then what you would do is you just buy the open, whatever it is, but then you'd be sure to have a stop loss that was big enough to accommodate that. And where is that? That should be clear down here at 168.97. We'll just call it 169. All right. So you get in at 176 and whatever, and then your stop loss is at 169 and whatever. So that's going to be $7 stop loss. And then what are you going to do in terms of how you're going to take profit? Well, my style, I like to win 2 out of 3 times. And in the classes I teach, there's all sorts of reasons why that is. So for you guys listening, that's the Malamute trade, right? Sled dog, pack dog, African hunting dog, whatever you want to call it. It's the pack dog trade. So I like to risk 2 to make 1. And anybody who's similar, this is not trading advice. This is not. Oh, by the way, last week, this is what this is the trade that I was doing, SQQQ. I guess I won't do that because over the shoulder you guys won't see it. I'll just have to sort of talk about it from here. SQQQ. I'm going to get ready to close that trade out for this week if the market opens and starts moving higher. If in fact it runs up and starts coming back down, I'll let it run because we could see some movement down. I'm not going to buy Disney right at the open. Okay. Real quick disclaimer. I'm not a licensed financial advisor. Everything I'm showing you here is just for your own due diligence. You got to take your own risk, make your own decisions. This is educational purposes only. I'm not telling you run out and buy Disney with me. No. Make your own decision, look it over, and decide for yourself. I am showing you an example of how somebody who thinks like me would go through this and all of the reasons I've talked about why I would consider doing this. My idea is that I feel like if I buy Disney and then I hold it for about 1 to 4 weeks, then I'm probably going to get a chance to take profits there, assuming the market doesn't just tank right out of the gate. So I got to wait and watch and see what's the market going to do, because the market just sells down hard. I don't want to buy Disney or any other stock. I want to ride that SQQQ trade that I put on last week. But if the market seems to go up a little bit or sort of hold support, or maybe if it comes down and then bounces right back up, either way, any evidence of holding support, then that tells me that the people want to buy this dip. Then I want to hurry and close that SQQQ trade, and I want to look to be a buyer on a stock like Disney that has a good story and has a nice entry signal like a gap that has a statistical advantage associated with it. So all that being said, as disclaimer, I'm going to draw a couple of lines here just so you can see a little better. If that is my entry, where are my exits going to be? Well, the stop loss exit is going to be there, and the profit taking exit is going to be about right there, because I like to risk 2 to make 1. See that? That's twice as big as that. Now, if you haven't been to my classes, you might look at this and say, what? That's stupid, Gordon. Just the size of the chart. You're saying this proportional size actually matters? That's silly. No, it's statistically proven. Yeah. The distance on the chart. See, if everything is random, if it all goes just randomly, right? Then if I'm twice as far away, for where I'm going to take a loss to where I'm going to go to take a profit, then that means I have twice as much of a chance of landing here than I do there, which means this whole setup is a 66.7% chance of winning. That's assuming prices are random. If my idea has any merit at all, then it's going to be better than that. Not much better, 3 to 5%. But that's what I found. First off, the gap itself has about a 3 to 5%. Plus these ideas that I'm describing, the turn of quarter or turn of month, end of month effect. The fact that I'm buying right now on the second day of the month after prices have dipped, right? That has a 3 to 5%. They're not cumulative. They're just, additive in the sense that, hey, here's a good idea, here's another good idea, here's another good idea. Going to nudge me a little bit higher in my probabilities of making a good trade. So all those things together, I feel like this is a great setup. Now, if you're the kind of person that's like, I don't want to just get in a tiny little hit. Besides, after all, if I make this profit, if I don't make this profit, I make this much loss. The loss is twice as much. That's just break even, right? Yes, it is, unless you have the edge, right? 3 to 5% edge over many trades. So you could say, well, what if I just move this up? like up to here, the top of Disney's range. That is a very good trade. You just have to know that when you do that, you're playing what I call the Babe Ruth game, where you're the home run king and the strikeout king. Yes, you're going to win big when you win, but you're going to win a lower percentage of the time by doing it. Just know that's that style of trade. However, if you feel like Disney's going to go good for the rest of the quarter, this is a better setup where you're going to risk one to make two or more. In fact, I wouldn't even put this in as an order. I would just put that one in and then let it ride by trailing higher and higher as you go. All right, we're 5 minutes away from the market open. Let's go back to the real-time look of NASDAQ and Aussie yen. Change back from Disney to the NASDAQ futures and bring back the Aussie yen on the lower AUDJPY. My time frames are all messed up somehow. I thought that would hold. One day will be fine. I'm going to dial these down to the 1 minute charts here. Yeah, that's right. And just look here in the last hour or so. Let's see what we're seeing. So these are the 1 minute charts on the Aussie yen down below. We're drifting higher on the Aussie yen and we're drifting lower on the NASDAQ. So even in the microcosm, we're still seeing the same thing. NASDAQ pushing lower, Aussie yen pushing higher. One of them is likely to snap back to the other because they remain correlated. So as we're going to watch into the final little bit, I'm going to change that. I'll leave it back open. So let me do a currency discussion right now. If you're a currency trader and you're like, oh, this is really good for U.S. stocks, glad you like Disney, Gordon, but I'm Forex. I'm trying to figure out which way to make money on an FX trade. Okay, let me help you out. Aussie yen. If Aussie yen is drifting higher and the NASDAQ's drifting lower, and these are 75% correlated, and the NASDAQ's going to keep going lower, guess what's going to happen here? We're looking 81.018 was the former high in the past few hours, and we're not too far off of that. We're just about 09, we're within 20 pips of that. So I feel like you got resistance right there. Is it 20 pips or is it 2 pips? Anyway, I feel like you got resistance right there, and this upward trend is suspect. I think we could see the Aussie yen drop, especially if the NASDAQ doesn't take off and start trading well, right? So let's get ready, because we're going to be looking at 1 minute charts here. 1 minute activity. And I'll stretch this down. I mean, I know they're all flat and squishy, but we'll still get a good look at it. All right, so that's the Aussie yen, and that's the NASDAQ. We are within 1 minute away. So this is the last bar that's going to close. And then this next bar that comes, that's going to be the open of the markets. I think that you're going to see the NASDAQ kind of go up and down, but if it goes down more, then the Aussie yen should go down more and follow it down. So an easy trade on the Aussie yen is you sell it and you have a stop at 81.08, the new high, or 81.09, just above the new high. And then if it follows the NASDAQ lower, it could trend for probably 20 pips down, whereas you got less than a couple of pips up. So yeah, but boy, these are both looking pretty green. Let's see, here we go, coming out the gate. What happens? Okay, not very big moves, but they are red to start. There is sellers right at the open on the NASDAQ. Okay, just in a couple of seconds, we saw some buying come in there. A little bit of buying, boom, in came the selling. Fascinating here that we've got the Aussie yen coming up even as that's going down. So 81.03, and there finally the selling is happening to sort of catch up with that. So with this thing coming down, that's why I didn't want to be a buyer right at the gate on Disney. Let it come down, let Disney see where you can get Disney at a bargain shop. Okay, so that was the first minute. It was selling. Now we got some buying going on. Now we've made two highs on the Aussie yen. I gave you the idea of go south on the Aussie yen. Just give that up. Get out. We're already wrong, and might want to look at figuring out where to go the other way, because that's a pretty strong push for buyers. It might be that the dip buyers are going to overwhelm there. That's a pretty good candle. We'll wait and see, because if the sellers still come in, push back down, right? But if not, then it's a great time to just go ahead and jump in and get Disney or whatever other stock you're looking at. So how you decide you're going to play the this activity, watch to see whether or not today is going to be a good day. You don't actually have to be a buyer today. If in fact there's a really strong up day in US stocks, then buying the next day and expecting to be able to hold for a month or more is still going to be a statistical good trade. So you don't have to be in any kind of hurry. If it's a strong up day, that rising tide will lift ships. If it's not a strong day, if we get a little bit of buying but we get more selling, that's you want to set off to the side. Speaking of which, look at that. There it is. Yeah. Boy, a lot of back and forth going on. But we had the first candle come out red. We had the second one push pretty good, a little bit of selling, and a lot more selling that came in here. So they're trying to make up their minds. Now, in just 3 minutes, we haven't made up our minds, and we're not fully clear on which way we're going to go. Oh, well, sorry. Mark has a great way of proving me wrong, right? Yeah, anyway, if uncertainty continues back and forth, then uncertainty means cha-cha dancing now. Thanks, sweet. If uncertainty persists for the whole day, I think that is like a tie, and in this case, tie is going to go to the seller, because this is the period of time where if buyers were enthusiastic, they should show up and be enthusiastic. So the default is we're still going to be doing some selling if we don't see strong evidence of buying. And that looks like evidence of selling. So I'm waiting. I'm sit back, wait, and let the SQQQ trade continue on and decide when to pull that off. So anyway, you guys don't understand my thinking, and I hope that helps you with your due diligence. And we will come back and look at it again next week to see which stock to buy. Until then, take care and trade well.